So, you want to be an it girl? Hi guys, and welcome back to Confessions of a Wannabe It Girl. Today I am joined by my dad, Nick Freygang, to talk about some things money related and how to invest in yourself and your future financially. So welcome, Dad.
Hi.
I'm so glad you're here.
I'm happy to be here.
Oh my God, I'm so excited to have you. So let's go ahead and start with basically, like, what do you say you do to people?
Well, I worked as an engineer for many years, but I also manage asset allocation for our family.
Very good.
So how things are invested in different things in different ways and how it's all managed.
Okay, very good. Love that. So let's start with
let me just say one thing.
Yes.
I am not an investment professional. That this is not advice that you should take out and think you're going to make $1 million with right away. And
right.
This is just my personal experience.
Love
and
that.
For entertainment purposes only.
Entertainment / learning. Just learning. Whatever. Okay, so let's start with the very, very basics. What would you say like an investment is?
I would say an investment is anything that is where money is or value is put aside and allowed to grow, or maybe is nurtured so that it is more in a future time, and that value can be harvested basically for retirement or for your kids or for something that you need later in life. So
would you say that the point of investing is really to grow, to put money in and watch it double, not hopefully double, but like grow in value?
Well, rather than talk about investing in particular, I would say there are a couple of important parts of money management in general that one needs to, that are beneficial habits, money management habits that are beneficial for long-term appreciation and happiness.
Right. And what do you think those are?
Savings of value. But the world has changed so much since when I was a young man. It used to be that savings was in a savings account and you just kept money in it and it earned a percentage interest that was somewhat decent and it grew and you kept putting money in that, and that's how you saved. But the world's become much more complicated, and now it's more saving and appreciating the value, preserving the value and preserving the growth or having it grow in value. And that may not necessarily be in dollars anymore. But the most important thing I would say is that, and we did this with you, is that you get in the habit of saving. So even if you're just out of school, come to a new town and you're trying to break into an industry and doing something on the side and just barely making ends meet. If you just take a little bit of money and put it away and not touch it and let it grow and keep adding to it, just to be in the habit of it, then when things are better, that asset can be changed in investment and used to grow in value.
Totally. And so let's just make an example. Let's say you've been saving for a while and you have a decent, doesn't necessarily need to be large, little bit of money, and you want to invest it into something. What are the things to invest in?
Well, I go back to the old adage that the best investment you can have is in your home. But home is different. I mean, especially in LA right now, you're not going to working odd jobs or gig jobs and trying to break into an industry. Totally. You're not going to have enough money usually to go out and buy a home. But you might be able to buy an apartment, enter and buy it with a friend or your significant other or something like that. And maybe you take in roommates to help make the payment. And if you can figure that all out, then that's an investment too. And that's a good investment, especially if you can, in these times, structure it so that the income and the payments are met. And there's a lot of complexity to that. So let me just say that I've dealt with a lot of professional investment advisors and nobody, one of them who I have great respect for, always preface things by saying, well, I don't have a crystal ball. Nobody knows what the future is going to be. But given that, there are certain themes that emerge. And the problem with being young is that the themes that reemerge are new themes to them, to the young, whereas to the older, they've seen it before. And one of the things that is coming into prospects now is the prospect of inflation. And we really haven't had inflation in the last 40 years.
Right. What's the basic definition of inflation?
The simple way to explain it is prices keep going up. You go to the grocery store and all of a sudden the chicken, which was $5.99, is now $6.99 or $10.99. And so that's what inflation is to the consumer. And what one hopes is that one's income from working adjusts to the inflation, so that if prices go up, your wages might go up some.
Well, we hope. I think that doesn't necessarily always happen, but we want it to.
Yeah, well, and the government, the minimum wage usually it goes up. When I was a kid, minimum wage was like $3.50, and
oh my God.
And now, well, I just looked in New Mexico and it was $10.50. So which is still not much, but but it has adjusted some. But if you have an investment in a home, and you have it structured so that if you have some debt on it and that payment is fixed, it's not going to adjust. It's not a floating rate. Then you have roommates who are paying rent and you can afford the taxes, then that's a good investment. So the other thing about investments is that they carry risk, and there's a risk reward ratio. So really risky investments, if they pan out, will pay a lot, but the chances of them paying out are not as good. Whereas a safe investment, it will not appreciate in value as much, but it's a safer bet. So,
do you have an example of either?
Yeah, like right now, a lot of people are buying cryptocurrencies, and cryptocurrencies are relatively new, and they fluctuate in value greatly. And so if you put your money into a cryptocurrency, and then if you needed it at some point, let's say you're going to buy a car or something and you need the down payment, there's no guarantee that it's going to be worth a lot more and that you can just take that money out. You may take a loss at certain times, but over the long term, so far it's gone up, which leads me to the other thing is that the thing about a good investment is not to trade it, to stick with it long term. So if you buy a condo or something and have it set up so that it's affordable, not to move into a bigger condo or in a ritzier neighborhood or a better neighborhood, just to upgrade. So other investments, for example, if you were to invest in stocks or have a brokerage, rather than trade in and trade out, every time there's the chances of you're getting it right for the next trade decrease. Whereas if you just buy something that you think has long-term good prospects, then and just sit with it and not look at it every time and not look at it as a source of oh wow, that's money I've made, I can take that out,
right,
and just let it grow. So long-term, in the financial circles, they call it long-term capital appreciation.
Okay. So, and I totally agree. I mean, I've learned this all from you too, but I think it's so interesting because I think there's so much in like the fast pacedness of like the culture and like Instagram and social media. And like, you know, there's even apps you can invest your money in now on phone, like your phone, like you could just do it while you're like walking to the grocery store. I think there's such a idea of like getting rich really fast or like, you know, through like the new coolest wave. And like, you know, I think what I would really like to say through this episode too is like, I think it's really important to make the long-term investment, find the thing that's like in years, in time, appreciate in value, not just something like, oh, quick in and out. Cause like something we were talking about earlier, like there's just so much more risk involved in that. And I don't feel like that's talked a lot about in certain ways. Like, I just feel like it's so get rich quick, invest in something that's brand new. And like, you know, it's just going to blow up and you can get out really quick when really like, especially if you're young, you have so much time to invest something in something, it'd be a stock or like a home or something, and then watch it grow in time. And like, that is just not as publicized, I feel like.
Well, it's worse than that, actually, because in our society and the financial, so much of the financial business is focused on getting you to borrow money so that you can live like you made this money all of a sudden, and by borrowing it, when in fact what you're doing is you're shortchanging your future. And when you told me you wanted to talk to me about this, I went and checked out a couple of things, and I went on SoFi.
Okay.
You know, the SoFi's hip. I mean, and SoFi actually has some good products. But if you go onto their website and look at their products, most of it is about getting your money and borrowing against it, getting a credit card, getting a mortgage, refinancing your student loans. And there's a little bit about investing, that if you have money that you have not borrowed against, and you want to invest it, they have an automatic portfolio balancer.
Oh.
And and you can sort of go through a checklist of how you would like it, in what directions and what sort of returns and how much risk you want to take. And it's all automated. But most of their business is actually loaning money. And in fact, all the financial services companies now, they encourage you to borrow money against the assets that you have there, and then you can use it on that great vacation or that spiffy new car or something like that. But it's not it's doing you a disservice in the long term, because it's not allowing your investment to grow, because you're making interest payments and you have to buy down the debt. And in the worst case, in brokerage accounts, if the market goes down, what you're borrowing again is the assets of the stocks or whatever funds you have. And if they go down, you're subject to a margin call, and the brokerage can sell off your assets and get paid off and leave you with what's left.
Wow. Okay. Many questions there. First off, just for anybody out there who doesn't completely understand or whatever, can you in really basic terms explain like how the system of like stock works, or investing in something that has like a volatile, or not volatile, but like has a change over time?
Well, there's different stocks, and some of them are more volatile than others. The big companies like Nike is an example that it has some fluctuations, but relative to something like Nvidia or something.
What's Nvidia? I don't even know what that is.
Nvidia is a company that makes very fast computer processors that they use for self-driving vehicles and things like that.
So somewhat a new
artificial
company?
Intelligence.
Is it like new-ish in compared to like Nike?
It's relatively newish. It wasn't around 10 years ago.
So yeah, that's pretty new in terms of the stock market, right?
Or Tesla has quite fluctuation. So there's an example of a stock. So a stock is if you're going to start a company and you are going to need money to build your factory. There are two ways you can raise money to build it. You can convince a bank to lend you money, but that has a higher cost because you have to pay interest on what they lent you. Or you can sell stock or ownership interest in the company. And that's what stocks are, is they are ownership interest in the company.
Right.
So you actually own a little piece of the company.
And then because depending on how well the company is doing, that amount will go up and down.
Right. There are these people called analysts that evaluate what the current value of the company is based on its revenue and its assets and its market and they usually give a range of what the stock should be trading at.
So then you buy into a stock and you have a certain amount of shares in that company and it's made or lost money. And at some point you decide to do what with it?
Well, if you're going to buy an individual stock, it should be in a company that you have a great faith in. I think of my sister when I started out and explaining it all to her. There was this company that she really liked, that she really wanted, and it was called Snapple, and it had just become available on the market. And she bought Snapple, and I encouraged that, but I said, just hold on to it, keep going. It's going to go up and down, but long term, like 5 years later, and that's pretty long term, it got bought out by Schweppes, I think.
Okay.
So she didn't have to do anything. She just sat there with it the whole time, and it went up and down. But over the long term, it went up, and then Schweppes bought it, and she got her money back plus some. So, but stocks portfolio. If you're going to really invest in stocks, then you should build a portfolio of stocks, and there's all sorts of rules for portfolio balancing and managing, and I wouldn't suggest that to the small investor. There are things called electronic traded funds, and those funds can represent an index or an industry. So if you think, for example, that healthcare is going to be a growing industry, and at times it has been, then you could invest in a healthcare ETF. Or now there are socially responsible ETFs that invest in green energy and things like that. And you can invest if you think that that's the way the future is going to go, and if you want to invest in that. And once you have a small nest egg, let's say $100,000. Let's suppose that you're gig working and you're breaking into the industry and you get a good gig, a steady gig or a steady job in the industry that you've been trying to break into, and you have some real income coming in. It's probably at that time it's worthwhile getting a investment advisor.
How do you pick an investment advisor?
Well, often it's through word of mouth. Sometimes it's through so there are companies like Charles Schwab has investment advisors that they can refer you to. Sometimes it's a firm, but there's usually a contact person there, and you hope that they're going to be there for a while. And they usually have a brokerage license or a certified financial accountant's license, and they can help you invest. And depending upon how much money you have accumulated. Well, let's say you have this house and now your career is going to take you to another part of the nation. Like suppose you've had some success in LA, but now your career path is better suited in New York, and you need to move to New York. And you sell your real estate in LA, and you look at New York and you say, well, I want to make sure I'm firmly established before I buy something in New York. So you have all this money, and so that then an investment advisor would help you choose what investments you could put it in, so that later you could have that money to buy another residence in New York City or in the suburbs or wherever you're going. So, but investment advisors are not necessarily always acting in your best interest. It used to be that investment advisors were also, or the broker was made their money by commissions. So they were very interested in you buying and selling things and going and buying the next hottest thing and then writing it up, hopefully, and then selling it and then buying the next best thing. But long term, their record isn't as good as just holding the asset either in an index fund or by and large or a sector fund.
What is an index fund and what is a sector fund?
Okay, so an index fund is like, you've heard of the Dow Jones Industrial. That's 30 stocks of big companies. Or the S&P 500, that's the 500 largest companies that are traded stocks on. And then there's the broader NASDAQ, which is the National Association of Security Dealers stocks. And so those are they are not any specific industry. They include things like Apple and Google and GM and Nike and so it's a broad range of stocks, and it tracks what the market. So if the market goes up as a whole, they go up as a whole. If the market goes down as a whole, they go down as a whole.
So that's a really easy way to invest in a lot of different things and just kind of follow the trend of the market. Yes, that's very appropriate, especially for the smaller investor. The other thing you can do is there are now some brokerage services where you can buy quarter shares or smaller than one share. Oh, wow. Or you can buy a block of stocks, of diversified stocks that and not have to buy one share of each or whatever. So I don't know too much about those because I don't deal with small, less than one share. But it's become an influence in the market. The small investor has become the influence in the market, and that recently happened with a GameStop stock. Oh yeah, explain that whole situation. That might be a little more too complicated. Oh my God. I mean, but basically it was a bunch of people bought into it, right? Really on micro levels, and then it skyrocketed? Yes, well, there are all sorts of things that you can do besides just buy a stock. You can sell a stock and then buy it back. It's called short selling. Yeah. And then there are options too. So you can say, I'm going to buy the right to buy this stock at this price 3 weeks from now or 3 months from now. Wow.
And so you can gain access to a lot more stock at that time at a much lower price. So there are all sorts of complicated ways to invest, and it's only for the investment professional to do that. And
yeah, I feel like, the thing about investing is like, it sounds so complicated. There's so many different things. There's so many, like even the words, you don't know what they mean. Like it can be really, really overwhelming in this space, but it kind of goes back to what we were talking about earlier, that like, it's just really important to have like this mindset of like patience and time and like knowing the things you're investing in, because then like you also have an understanding of like, how that is going. Like if you invest in a clothing company that like, in 10 years is non-existent, like you were following clothing because you're just into clothing, like you see that start to happen. Like that's why like I think it's important to talk about investing in things you know and understand, but also the importance to like stress on like taking the time to let it just sit.
yeah, well, and it
What
doesn't
you've
have to
taught
be
me.
just stocks. It could
Sure.
be apartments.
Mm-hmm.
If you had one or two rental apartments in different neighborhoods and you bought it when the neighborhood was down, but you knew it was going to come up because of whatever reason,
Mm-hmm.
or cars,
Right.
like your uncle Chris. He buys cars and he keeps his cars. He keeps them safe in the garage and he drives them once on a nice sunny day or something like that. But he
Sure.
knows certain cars like that, 58 Alfa Romeo that is gonna
No, I don't know it, but
value.
someone does. Yeah, it's going to keep going.
Yeah.
Do I know that car? No, but that's the thing, is like knowing the trends, it's like, I think I've even felt it myself. Like you get so overwhelmed, or like you don't really understand. There's so much like lingo, and it's like, really, no, it's just like, okay, think about the things. So like for me, I mean, TV and film is kind of like a hard one, but like I think about the popular places or the popular music festival companies or popular clothing that's like popping off, or I think Nike is such a great example because it's such a stable company, and like it's kind of like at the top of its industry. So it's like, it doesn't have to be that hard, if like there's a vintage PlayStation, I don't know, I'm completely making this up, but like in 20 years that PlayStation is going to be worth a lot, like holding on to that PlayStation is of a value. Like, I think that's where it sounds so complicated, but also like you can make it simpler for
Well,
yourself.
if you're in the business or it's enough of a hobby,
Mm-hmm.
then you can invest some of your investments in that. So, especially if you can protect them, like housing a car in garages and keeping your apartments in relatively good shape and neighborhoods that won't get burned down like by forest fires or whatever.
Totally. Or,
You got to balance the risk.
right. You have to look at also like with that, like the climate, like,
Mhm.
is it going to be underwater in 50 years or 100 years?
Right.
That's going to have an effect on the investment. So it's like understanding the factors around whatever you're putting your money into.
Right. So I just want to go back to the brokers.
Yeah, go back to it.
So most brokers are investment advisors that are suggesting that you invest your money in certain ways. Do not have to put your interest above their self-interest. If they're going to get money from it, and they might encourage you to go into that investment, and they are not what's known as fiduciaries.
What's that?
A fiduciary is somebody like a trustee of a trust. Suppose in the unfortunate example that a child is left orphaned, and because their parents were deceased in some sort of accident or something like that, and then the court might set up a trust with the parent's asset and appoint a trustee. to manage that trust for that child. That trustee has to put the child's interest above his own interest in the making of investment decisions.
As they should.
That's a fiduciary responsibility. But most brokers do not have a fiduciary responsibility. So, for example, if you were going to buy a house and you had stocks and you had the down payment and wanted to finance it, the broker might say, well, you got stocks that you can borrow against. Why don't you just make your payments? We'll set it up so that you have your debt at the brokerage account, and you can pay off the rest of or pay off the mortgage to us. But in fact, because it's a debt that exists in a line of credit that exists in the brokerage account, if your stocks go down, they could start selling them off, and because your house is not the asset you're borrowing against. That's legal for them to do it because they make a little money off of that arrangement, and it's so, and you can't sue them for that because they were not a fiduciary. They did not have a fiduciary interest.
So it's definitely something to look out for when getting involved with that kind of.
Right, because if you have a brokerage account or a SoFi account or something like that, and you are going to use it as a real savings of value, then you shouldn't have a credit card on it. You shouldn't look at it as a source of to borrow funds on. You should keep it debt free. And so that if you get in trouble, you don't, or the market goes down, that you don't have anything sold out from under you.
Right. Like owe money on it instead of just having money trying to grow and taking more out against it.
Right. You should not, to really grow an investment savings in value, you should not borrow against it, and you should not take money out of it. You should only put money into it until later in life.
What do you think, like generally speaking, what is a short term and what is a long term?
Well, by the tax code, short term is anything under a year.
Okay.
So if you hold an asset for more than a year and you sell it and you have a gain, that rate is lower than if you had sold it in less than a year. And what the rates are, they're going to change now again. They're always changing over the years, but by and large. So. And
what's a long term?
A long term is typically 5 years, but 10 years. And at some point, when you hold things 30 years, and there's some things that we've held that long, then the basis of it, the cost of it is so low compared to what you could sell it for and how much gain that it becomes painful to sell it. Yeah. Because if its cost basis may be $1, but its sale price may be $100. So you're going to have to pay tax on $99, and that can be half. So you could be paying $45, $50 in tax. So it's just a sort of rule of thumb. So that kind of hurts. You think, well, I've held it this long and it's worth so much more. So, and the way to do that is to sell a little bit every time, every year or so, and whittle it down.
Gotcha.
And that goes back to portfolio management.
Which also goes back to my point of like, it's just not fast. Like, it's not a fast thing. Like, it's like so then you have to sell, it might get really big, but you should sell it off slowly so that you avoid the tax. It's like, no, there's no quick, like super quick investment thing that doesn't come with super high risk, super tax, or, also just is like scary and like overwhelming too.
Well, yes, the best thing to do is to be able to sit with it long term. So you shouldn't be looking at that money as money that you are going to need unless it's an absolute crisis, a personal crisis. But if you have it as a nest egg and are able to sit with it in that nest egg through a market crash or correction, like in 2008 when property values and the real estate market and everything went down, there were a lot of people who got so disgusted that they looked at their portfolios and said, well, it's worth half of what I put into it. I'm going to get out now. And that was absolutely the wrong thing to do. The right thing to do was to not look at it actually, and just wait and say, well, it's already lost that much, so
wait for it to come back around.
Wait for it to come back around. And the people who did wait then made back their money and have gains again. So
right. And that goes back to what you said at the very top, like trends will come and go and they seem new to people my age, but like things circle. So it's again, another reason to hold on. Something else I want to talk about really quickly is like, you've taught me this. It's like diversify. Did I just say that right? Diversify. Like you don't want to put it all in just one thing, because if one thing goes completely awry or whatever, you need to have, it's spread in a couple different places. And so like, we just keep using Nike, but like Nike, like you don't want to put it all towards Nike. You don't want to put it all towards just one apartment in one location or one PlayStation, blah, blah, blah. It's important or one car. It's important to have it spread in different things, because different things are going to have different points at different times.
Right. Well, that just real briefly, that gets to, if you're going to diversify your portfolio, the simple rules of portfolio management is if you can spread between 20 things, let's say your Aunt Esther wills you $100,000 and you go to your broker.
Love Aunt Esther. We don't have an Aunt Esther. We're just saying Aunt Esther.
Right.
Yeah.
And all of a sudden, then you think, well, this should go towards my nest egg, my investment. So you go and you would buy ideally 20 stocks that you believed in, and like if you believed in Nike or Nvidia or whatever, and so no stock is more than 5% of the portfolio. And then let's say like Nvidia has gone up in price, or Tesla or something like that, gone way up in price. And you maintain a little spreadsheet that says, well, this stock has grown so much that now it's 10% of the portfolio. So what you do is you sell enough of it, not all of it, but enough of it to knock it back down to 5% of the portfolio. And you take that and you look at either spreading it among the other stocks or maybe a new stock that you want. So it may go up to 30 stocks over the course of 15 years or something like that. And or the company gets bought out, or something changes and you don't have faith in it anymore, and then you find a replacement for that 5% position. That's what portfolio management is. And the brokerage company SoFi has a balanced portfolio. So and it's automated. So it does it every quarter. It figures out how the ratios are of your stock. So nothing's more than 5% and nothing's less. If it goes down to 1 to 2.5% and you feel differently about it, then you might sell it. But that's active management, as opposed to passive management where you just buy an index fund.
Right.
And then there's sector funds that, for example, you can buy telecommunications sector funds or green energy sector funds or oil and gas sector funds or healthcare sector funds. If you think that some part of the economy is going to do well, then you can invest broadly in a bunch of companies that do that.
Yeah. Well, Dad, you have been so fun to talk about financials with. Is there any final thoughts you have on money and mindset? I
would just be careful not to think that the money you can spend by borrowing money is reaping gains. That's not this. Our society is so bent on loans and consumer loans and and God forbid, payday loans or car title loans that have high rates of interest. Debt it's not necessarily bad, but it needs to be very carefully monitored. And in the prospects of the economy now, you don't want to have a variable rate. You want to keep, if you have to have debt on student loans or something, or a house or a car, you don't want to have that rate fluctuate. You want to fix that rate so that your payment is something that you can make a payment on comfortably for the life of the debt, the term of the debt. And other than that, just keep accumulating value in whatever you're investing in, and don't trade in and out of it, and don't trade it out at the bottom of a crisis or something like that. Stick with it, and don't look at it that often.
Don't look at it that often. So funny. Well, Dad, thank you so much for being on the podcast and talking about these things that have been so overwhelming. You've taught me them throughout, I think, my entire life, and it's definitely paid off. I feel like I have a better understanding, and I hope somebody who listens to this has somewhat of a better understanding about it too. So, Dad, where can people find you? You can give them your Instagram handle.
I don't have an Instagram handle.
Yes, you do. I follow you on Instagram. I think it's Freygang. You literally have an Instagram account.
If it is, it's Freygang.
So you can find him on Instagram at Freygang.
But the best way to get me is through my email, nfreygang@yahoo.com.
There you go. If you have any questions about the episode or just general questions about this, you can hit him there. So guys,
I tried to keep it simple.
We tried to keep it simple. Right. I know. I warned my dad before this. I was like, we can't get too complex, because even when you get too complex for me, I'm like, ah. So we hope you guys learned something. Thank you guys so much for listening. We'll see you next week.